Good evening, everyone. My name is Siti Noraziza, and I'm here to presenting the article written by In Ji Jang, Namho Kang, and Ari Yezegel. This article is from Journal of Banking and Finance, and the topic that I'd like to present here is common ownership, price informativeness, and corporate investment. First, introduction. In this study, the writer examined the capital market implication of common ownership. Specifically, they study whether increases in common ownership contribute to price informativeness and influence the share price sensitivity of managers' investment decisions. Their first hypothesis is common owners information-based activities contribute to price informativeness by improving the level and quality of information that is produced. The writer consistently predicts that the efficiency gains that investors achieve by holding multiple stocks in a particular industry increases their willingness to obtain new information. The second hypothesis that common ownership can enhance price informativeness through a supply-side channel by altering managers' incentives to disclose. In the second hypothesis, in contrast to the supply-side argument, the decision to increase disclosure may not represent long-term commitment. And that is the opinion from Lewis and Ferrechia in 2000. And or the content of the incremental disclosure may not be substantive. Finally, in the second hypothesis, common owners can directly contribute to the informativeness of share prices through their trading activities. Common owners' trades may be due to private information, or they may be due to liquidity reasons. In the second hypothesis, the writer finds that firms with positive shocks to common ownership experience an increase in the extent to which their share prices reflect future earnings information. They also find that the positive relation between current returns and earnings is weaker for commonly held firms. Their analysis show that the increase in price informativeness is more pronounced for treatment firms that experiences larger increases in disclosure activities, suggesting that the gain in price informativeness generated by common ownership is true, at least partly, associated with the increase in a voluntary disclosure. And the third hypothesis, they study about common owners trading activities as an additional channel, and they find that common owners trading activities become significantly more correlated with contemporaneous returns for treatment firms following exogenous shocks to common ownership. And this result imply that increases in common ownership for treatment firms lead to more information trading by common ownership. 2. Main variables and methodology. The first main variables is common ownership variables, and second price informativeness and corporate investment variables, and the third summary statistic. They use merger of a financial institution that took place between the years 1983 and 2011 as the methodology from their research. They identified treatment and control firms based on ex ante holdings information rather than actual post-merger holdings because relying on the latter can introduce selection bias. They examine whether mergers are associated with changes in the level of common ownership for treatment firms. And this is the result. From this table 1 is the summary statistic, and panel B is the correlation. Panels A and B of the table 2 provide summary statistic of the common ownership variables during the pre- and post-institution merger periods respectively. And this, the panel A, demonstrated that there are no significant differences in common ownership variables, except for n connected and average number between treatment and control groups before the merger. And here in the panel B, they find that all 5 proxies of common ownership significantly increased for treatment firms during the post-merger period. And here the result in panel C reported that confirmed firms in the treatment group experienced increase in common ownership during the post-merger period. In an untabulated analysis, they also estimate the same date analysis using total institutional ownership as the dependent variable. These findings rose to the possibility that their findings may be driven by changes in institutional ownership as opposed to common ownership. The third main empirical analysis between common ownership and price informativeness. This is the result presented from price informativeness. In Table 2, provide an empirical basis to use financial institution mergers. They estimate the following generalized difference in difference model that appear here. And this is the report from the Table 3. This is the result of their analysis. They include various combinations of industry, firm merger and year fixed effects to account for unobserved heterogeneity across various dimensions. And this is table 4. Report the results of table 3 and 4 using cluster standard errors at the merger level in table A1 of the appendix. And the results show that the estimated coefficient on X2 are generally positive and significant, which indicates that firms that have a sold to common ownership experience a significant increase in the degree to which their share prices reflect future earnings information. These findings support the conclusion that common ownership contributes to price informativeness incremental to the effect of the overall level of institutional ownership and other factors. They find that share prices react to contemporaneous earnings to a lesser degree for treatment firms relative to control firms during the post-merger period. And finally, they study whether the increase in price informativeness is related to the actual trading activities of cross-holding institutions. And this is the analysis. The second analysis, they investigate the effect of voluntary disclosure on the price informativeness in 2 distinct ways. The panel A of table 4 is recategorized treatment firms into low and high treatment. This is the report from panel B. And overall, their analysis of the change in voluntary disclosure shows that the increase in price informativeness due to common ownership is in part driven by the increased information supply through disclosure activities, and they find that treatment firms with larger increases in voluntary disclosure experience greater improvement in price informativeness, and these results are consistent with the view that commonly held firms' tendency to provide more information to investors help share prices reflect future earnings information more efficiently. This is the third point. This is the 3.3 attentive institution and co-search activity. In this section, they examine whether common ownership changes overall information production. They study the question of whether the financial institution merger strengthen common owners' incentive to acquire information. This is the result, the table 5, panel A, motivated institutional holdings. Panel B, about common information search. And the estimation result revealed that the coefficient on the interaction variable is positive and statistically significant for all model specification. 3.4 Geographical distance and social connectedness. In this section, they build on the results of the prior subsection and further investigate where common owners contribute to the flow of information between connected firms. They find that point towards trading activities as a mechanism through which common ownership enhances price information. Number 3.6 Active trading and price informativeness. This section is examine the relation between price informativeness and the trading activity of merging institutions. For investment to Q sensitivity, they use a quasi-natural experiment based on financial institution mergers to produce evidence relevant to their understanding of the causal relation between common ownership and investment to Q sensitivity. They estimate the DID regression model presented below. This is the report, table 9. The report from investment and overall, their results support the conclusion that managers of commonly held companies rely to a greater extent on stock prices when making investment decisions, combining our result in the previous section. They argue that as firms' share prices become more informative due to common ownership, managers rely more on stock prices, leading to a greater investment to Q sensitivity. 5. Robustness checks and falsification tests. In this section, they conduct a series of robustness tests. First, they follow Llewellyn and Lowry and construct an alternative control sample based on size and industry to mitigate concerns of control firms in the main analysis being in different industries from the treatment firms. For each treatment firm, they first select firms in the same 4-digit SIG industry but not block held by merging institution. Then match the 5 firms closest in size to each treatment firm. This analysis ensures that the informational efficiency gain due to common ownership is not driven by differences in industry or size between treatment and control firms. This is the report from Table 10, Panel A, Price Informativeness. In price informativeness, their share prices begin to reflect future earnings more efficiently after an increase in common ownership. And next, perform a placebo or falsification test by using the T4 period. And they find no significant relation between future earnings and stock returns for treatment firms after the pseudo event. And overall, evidence in Table 11 supports the conclusion that there are no significant differences between treatment and control firms in price informativeness and investment to Q sensitivity in years prior to the actual event year. And according to their hypothesis, share prices or companies with greater common ownership are more informative than firms with less common ownership. To test the effect of common ownership on variance ratios, they estimate the following regression model. And table 12 is the results. The results here are consistent with their hypothesis. All specifications reveal statistically significant. Conclusion. This paper investigates the effect of common ownership on share price informativeness and investment to Q sensitivity, using financial institution mergers as a source of identification. They find that positive shocks to common ownership lead to a stronger relation between current stock returns and future earnings news. A sensitivity analysis, they also show that common ownership is associated with a reduction in variance ratios, suggesting that share prices of commonly held firms are less influenced by noise traders or liquidity shocks. Finally, they show that the trading activities of merging institutions are more informativeness for treatment firms, and the post-merger informativeness can is created for treatment firms for which merging institution activate trade. And they also find that geographically and socially distant peers experience greater post-merger gains in informativeness. And they find that the motivated institutional holding increase after the shock, and the frequency and proportion of co-search activity in SEC filings increases among treatment firms, implying that users of financial information began to more frequently analyze treatment firms comparatively. And that is my presentation from this article. Overall, thank you. Good evening.